Arrival stock was down by 25% on August 11th when they announced their Q2 results and an adjustment to their plans to produce and develop new EV programs. But how does this compare to their peers in the industry and what we can expect from Arrival in the near future? Well, that's what we'll be talking about in this episode. Arrival is a UK-based startup that's famous for its deal with UPS for 10,000 delivery vans and its unique microfactory manufacturing concept. Another product in Arrival's pipeline was an electric bus. After going public via SPAC in March 2021 and raising $660 million, Arrival decided to add one more EV to its product portfolio in partnership with Uber. It was an electric taxi focused on cost efficiency, durability, and overall roominess. The concept was unveiled in December last year. So, what exactly was it that Arrival announced last week that would scare off so many of their potential investors? We are switching from the mode where we have two products, two shifts, and two microfactories to the mode where it's one factory, one shift, and one product, CEO Denis Sverdlov said during a call with analysts. The company also lowered its delivery plans from 400 to only 20 vehicles this year. Let's zoom in and analyze the CEO's statement bit by bit. One factory means that Arrival is focusing on their manufacturing site in the UK. The original plan was to also launch a factory in North Carolina in 2022, but instead, Arrival asked 35 people in Charlotte to leave the company, therefore reducing the total headcount to 60. And while Arrival is reducing its workforce by 30% globally, it seems strange to lay off people employed at your manufacturing sites. Personally, I believe this is related to another element of the CEO's announcement, focusing on one product. The team that was working on the bus project was let go. By the way, there is a bit of confusion here that we should address. In the beginning I said Arrival was developing 3 electric vehicles, a delivery van, a bus and a taxi. However, how does that fit when Denis Sverdlov said that Arrival was switching from 2 products to 1? What I read here, looking between the lines, is that the ride-hail electric vehicle has never moved from the concept prototype phase to real development. And my guess is that the reason for that is a lack of commitment from Uber. While Uber would always be happy to talk about transitioning to a zero-emission future, the ride-hailer was probably not ready to commit to volumes as opposed to the announced partnership between Arrival and UPS. Overall, engineering a new ground-up EV platform is a $1 billion exercise. While there are many shared components between the 3 EV programs Arrival had kicked off, they are all very different in terms of their dimensions. This means that much more heavy lifting is needed than just swapping an upper body, as Tesla did as an example by adding a compact SUV upper body to the already in production Model 3. Looking at the Arrival's $90 million burn rate and the remaining $513 million focusing on one product is a wise decision at this stage. However, I am not too concerned by this burn rate. After all, let's consider here that Lucid lost $800 million and Rivian was as high as $1.7 billion. You may say these companies are playing in a different league, but even Canoo has posted a net loss of $164 million. Making a loss is almost inevitable for early-stage EV startups, and don't forget, it took Tesla a decade to demonstrate an indication of being able to be profitable in 2013. Moreover, I wouldn't be surprised to see losses deepen closer to the mass production stage, which is when the brand will need even more capital. The trick here is to have a good runway and an ability to raise additional capital when necessary. And on that front, it looks like Arrival has some confidence. The company says it has created a $300 million platform for selling stock occasionally to help it raise funds. Thus, with the tailwinds in the market today, I personally wouldn't be too concerned. Arrival is doing all the right things by adding much more discipline and focus. Therefore, the key parameter to watch now is their ability to execute on their plans. Cutting back the 2022 manufacturing target is not an unusual event either. This happens to all new car makers all the time. Peter Rawlinson, the CEO of Lucid, took that bitter pill several times by acknowledging that the test EVs coming off the manufacturing line were not meeting the quality standards that aimed for. I personally respect this decision made by both CEOs, but it's absolutely critical for Arrival to deliver those 20 units by the end of the year in the best possible condition, or there could begin to be potential consequences. My take: investors are perhaps overreacting to the news from Arrival, and it's definitely a matter of trust. On the one hand, they have seen good progress by Arrival completing certification of its EVs in Europe. However, on the other hand, they may hear about the global workforce reduction, shrinking EV lineup, and delivery delays and worries. The decisions made by Arrival CEO are harsh, but they may be critical for Arrival to succeed and put the company on the right track. I personally remain optimistic, but what do you think? Let me know in the comments here below, and don't forget to subscribe. Bye!